There are more self-storage facilities than there are McDonald's and Starbucks combined. People don't understand that. The amount of storage facilities out there for a newbie to go and find and buy is crazy. The level at which you get started, to me, is actually irrelevant. Your ability to find other people that can do it. As you know, with real estate, you don't need money, and you actually don't need to know how to do it. You just need a deal. You can find people that can do it, and you can find money. You just need a deal. You can do big deals. You just can't do them alone when you're starting out. I think it's the best opportunity for any investor to get into commercial real estate. The most upside, the lowest risk, but more importantly, the most opportunity, where there's just endless mom and pop facilities that are being ran like trash. They don't even answer the phone. And you can buy them and do the bare minimum and make money.
Text me and I'll text you back. Text me and I'll text you back. Text me and I'll text you back. You text me then I'll text you back. Text me then I'll text you back. TikTok, you don't stop. I will help you make your paper stack. Where you at? Where you at? Where you at? Where you at now? 205-964-5243. 205-964-5243. You know.
Hello, guys. This is Ty, aka the Flip Man. And today we have a very, very special treat. Today we have a seasoned veteran commercial investor, mainly in the self-storage space, which you've heard me talk about time to time, have others on that have discussed that form of real estate investing. So my man AJ out of Boise, Idaho is here to give us some insight on how the business works. He has a really, really good YouTube channel. I've been consuming the content. I reached out to him. He pretty much responded immediately and said, yeah, sure, let's do it. So this is your opportunity to take advantage of me learning from an expert. And as I grow in my real estate investing journey, you'll be able to do the same thing if you want to go down this path. But enough of me yapping. What's going on, AJ?
Not much, man. You know, it's a funny question, right? What's going on? It's like you never know how to respond to it. It's like, well, I run 1,000,000 miles an hour. We've got over 150 million under contract. We've got 850,000 net rentable square feet under development. So we are cruising and very, very busy.
I'm assuming you're looking for more, right?
Always.
All right. That's what's up. All right. So let's do it. I like to do this just to give a little background before you got into self-storage or just commercial real estate in general. If you just give us a little background about yourself, and we'll build up from there.
Yeah, happy to. I followed in my father's footsteps into insurance sales. So sold insurance. And that seemed like, the absolute way to go because I felt, I'm in control of my own time. I have the income potential was mine. So I liked that. I liked sales. I really liked that mode of operation. And I tell people, I got into insurance to try to get rich. I got into real estate to get wealthy. And a lot of people know that when you're in that kind of line of work in that business, it becomes a treadmill, right? You're just like, you're running 1,000,000 miles an hour, but you're only as good as the amount of sales you can do.
Yeah.
And it got to a point where we were growing, making good money. My clients paid me well. It was an all commissioned gig. But I started to really get nervous that it was like, man, I stop and this is over. There's no buffer. There's no break. There's no anything. And so we really started to get into real estate, but I didn't know anything about real estate. So we got into self-storage because I looked at self-storage very differently. I thought self-storage is a business. It's not real estate. And so I liked that about it. I thought there was more upside potential, and I didn't have to deal with some of the problems that real estate has, mainly when you're talking about tenants and things like that. So we got into that business, started growing it, and we were doing that while I was working. insurance full time. So I was selling insurance, working for my clients, all full time. That was going along while we were trying to build up our real estate game, right? Our real estate empire. And everything, it was going good. I was killing it at both things. Now, from there, things took a turn for the worst, and I actually became paralyzed from the head down. So I became a quadriplegic, put on life support, lost my job in the hospital. We'd sold our practice to a big national company, and I'd worked for them, and I was running that business, everything else like that, which I obviously couldn't do. I was hooked to tubes. I couldn't even talk. So from there, I lost my job. And, I view real estate as it saved my family's financial life. Mm-hmm. My wife, we'd had our fourth kid 3 months prior. So we had an infant, 3 kids, the oldest being 9 at the time, or 8. And so my wife's got 4 kids, an infant newborn, and now a quadriplegic husband hooked to tubes on the hospital. And with no exit date. They moved me from the hospital to an LTAC, which is a long-term care facility where they could support me. And then from there, did that whole thing, got off the tubes, went to rehab, and then tried to come back, tried to get back, occupational therapy, everything like that, try to relearn how to walk, and for the last 5 years, been coming back. And since then, I was lucky I had real estate, and that kind of lit a fire under me. And I was like, not only is this the only thing I'm doing from now on, because when it mattered, real estate was the only thing there. There was nothing else. It was income producing assets. Everything else was gone. And so I'm like, I'm not wasting my time again on anything else. And we went all in. I built 3 companies out of a wheelchair, sold one of them, kept the other 2, including a private equity company that is basically my full-time gig now that we run and do self-storage. We look for underperforming assets. We turn them around. So we're buying cash flowing underperforming assets and we turn them around. We now have over 80 employees. We're across over 10 states. I have 23 more locations that are under contract and hiring a lot. So it's been a interesting last 10 years for me.
Wow. Okay. Just out of curiosity, what caused the accident? I mean,
So it's it's something called Guillain-Barré. So Guillain-Barré is when your central nervous system gets what we call triggered. It's not like a disease or anything else like that. We all have it because it's our own nervous system, but it gets triggered, and then your white blood cells start getting reproduced at like astronomical amounts. So your body's just dumping out white blood cells, and those white blood cells go straight to the central nervous system, and they killed my own nervous system.
All right. Okay. All right. Okay. So you sort of went, you were doing the insurance, but you had already started real estate.
Yeah.
So did you pick self-storage from the beginning, or it eventually happened?
No, I actually picked self-storage from the beginning, which it was weird because I don't know how long you've been in the game, but we're talking the early 2000s. And at the time, nobody invested in self-storage. Like, it was a weird asset class that you couldn't even get money for. Like, banks didn't want to lend to it. It was not an easy asset class to be in. There was no third-party management. There was nothing like that. We had to do it ourselves. But cap rates were exceptional. So when I was looking in the early 2000s at all these people that I knew that were getting very wealthy on single-family homes, we're talking 2005 here, right? And so this is the time of overexposure, overindulgence, and
it was great. Like what just happened was good, but I think because I've seen both, it was better back then, in my opinion.
Yes.
Some people may differ, but I've experienced both. And that's when I got into business in 2003. So from 2003 basically to mid 2007, all I knew is I was making more money every year. I didn't know a quote unquote crash could happen, but I was technically still new to real estate. All I do, I was just, I was living that way too. So, but anyway, so yeah, so
I was right there with you. I was a year after you. So, I came in right after you. And I didn't understand real estate. So I didn't understand how it worked, anything else. So when we looked at storage, the cap rates on the asset and cap rates, when we talk cap rates, for anyone that doesn't understand what a cap rate is, all a cap rate is how we use to value commercial real estate. Generally speaking, a cap rate is just like how we define a return. So let's say that you're getting a 10 cap, right? A 10 cap means if you bought a deal for $1 million, you're getting $100,000 a year. A 5 cap would be 50,000. So if you spend $1 million, that's your return. That's how we define cap rate, not including debt. Now, we were buying at 10, 11 caps. To give you any idea, that is like today, you don't buy things outside of like a 4 cap. So our returns were like 3x what we could get today just on acquisition. So the reason being is nobody did storage. It was, it was just a hard asset class. Nobody wanted it. Nobody thought it was going anywhere. That all obviously dramatically changed after 2008. So
since you started then, well, I don't want to get ahead of myself. Okay, so do you remember the first property you ever bought?
Yeah, some dinky little facility in a town that nobody knows, out in Idaho, like northern Idaho, like up by the Canadian border. Like it was like, I don't know how many people live there, but it was like nothing, man. Like it's like, it was a one street town. But that's what we could afford. And that's where we went. And it was you're talking about a handful of units where there weren't tops of units. There's dirt just on the side of the road. And that was the first one.
Do you remember, did you all pay cash for it, or you financed part to pay cash? Or how did you pay for it?
We financed it. We put all in, it was 200,000 down on the property. The property was, I don't know, 500,000, something like that. It was like 40% down. If I remember that correctly. And it was with a regional bank, that the purchase was primarily defined off us and our ability to pay the mortgage based upon our incomes, which in commercial real estate is not normal. It's normally they look a lot more at the asset, but at the time, storage was just so new and stuff. They didn't look at it like that. They looked at it more like I was buying a house, right? And so that's how we got money for it. But yeah.
Okay. All right. So what changed to make it attractive to like even institutional investors like REITs and stuff? What changed? I know you say after 2008, so you were there before it happened. So I assume you bought some more before the quote unquote crash in 2008.
Yep.
So what do you think changed as far as mindset of investors on a larger scale to start to look into it? Because Public Storage and U-Haul, they've been around. Even they were in it already, though, right?
Oh yeah, they were in like the 70s. So storage actually originated out of the 70s. Nobody really understood until it started like the late 90s, and then the early 2000s, people started to use it a little more. But the two things that was holding storage back for all that time, first of all, it was the newest commercial real estate class out there. But really, it was a financial and a management problem. There was no institutional grade third-party management companies. So institutional money, like let's say that you're a fund and you have 10 million to deploy, and that could buy you 5 storage facilities at the time or 10 storage facilities or whatever it was. How are you going to run it? Because storage is admin heavy. Like I view it as like a retail center. So like we have people coming in and out every day. We're always selling because they have short-term leases. Right. Now, it's not admin heavy on things like the asset basis like other ones, like housing, apartments, right? Then you got toilets. That's a totally different type of admin. We're talking more the business side. We need to do marketing, right? We need to do revenue management, things like that. And so because they couldn't do it, or they couldn't hire somebody else to do it, they're like, well, we can't. I'm not going to go run a storage facility. And then the models that institutions use to predict performance of assets, they all generate the principal models of institutional money have benchmarks that are in certain economic cycles to test performance so they can judge risk. Self-storage was so new, it had never really been as an asset class through a credit cycle, contraction, anything else like that. So they didn't really know. There was a lot of people that were like, you go into a recession, everybody's going to stop paying for a storage unit because people are going to stop buying stuff. And that was kind of the defining theme, was this is actually very recession sensitive because people will stop buying stuff and no one's going to pay for a storage unit when they're not making money. Well, that turned out to be totally false. And that was the big change. After 2008, the models could actually test. And they said, not only were those assumptions wrong, self-storage was the best performing asset class through the recession. That blew everybody away. And then you had Extra Space, that was a storage company, step in and say, we will do institutional grade third-party management. And that changed the game. And then all of a sudden, funds, investors, banks started pouring in. I mean, as we said, over the last 26 years, self-storage is the best performing real estate asset class. It is the lowest defaulting one. So it's not even comparable when you look at other asset classes. If you go back over, even just go back through COVID, the default rate on self-storage is less than 3%. The next closest one that comes to that was, I don't have the date in front of me. That might have been mobile home parks or multifamily. And it was like 5x more, the next closest one on default rates. So investors were shocked at not only the performance, the returns are astronomical compared to most real estate over that period of time. The margins are huge. CapEx is really low. And it's outrageously recession resistant. And that just made investor demand go to a feverish standpoint after 2015. So after 2015, when everybody started jumping into real estate, everybody was burned by houses. They were burned by all sorts of stuff. I mean, you got to think about all the golden gooses in the real estate economy have basically been killed. Retail, prior to 2008, was like considered a government bond. It was so consistent, so predictable, because there is no way that the biggest companies in the world, like Shopko or Kmart, will ever default. It will never happen.
Yeah.
These are institutional grade returns and bonds. They looked at Kmart and retail centers that had a Kmart in it like it was a government bond, and storage like it was trash.
and now a lot of the former Kmarts are, guess what?
Storage.
Converted self-storage.
I buy them and make them into storage. So it completely flipped the script for so many investors. And then also hotels, which were devastated. You had like these, housing, retail, hotels across the board. They were just obliterated during the recession. And everybody was scared. And they're like, where do we put our money into real estate? Well, that led to mobile homes, industrial, and self-storage, because those were the good performers. And then everybody wanted them, and money just kept flowing and flowing and flowing. Then it got to a point where self-storage facilities were trading at the exact same cap rate as like multifamily. So remember, cap rate is a measurement of returns. Well, it's also a measurement of risk. So if I believe that there's a lot higher risk, I have to pay a lot higher cap rate to adjust for the risk. So I need way more returns. Well, that doesn't make sense, because logically, multifamily is actually much safer than storage. The reason being is it has long-term predictable contracts that generate that cash flow. Well, all of a sudden, the demand was so high for storage facilities. Storage facilities were trading like much safer assets. And that, I mean, talk about a 10-year swing that made those of us that were in it very wealthy.
Wow. 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 That's a interesting breakdown of what happened and how that transitioned. One bad thing happened and it created just a whole nother mindset on a whole nother investing opportunity that has existed, decades before. That's so interesting. All right, so let's get into if someone wanted to actually start to do this, right?
Yeah.
And what's going to be, we'll start with what do you think are minimum financial requirements to get going? Whether it's yours, someone else's, or whatever. So let's go from there.
Yeah. So one of the things that has gone away largely, when I got started in it, I could get owners to basically seller finance the whole thing. So we could really utilize our capital where we're going to give a very little down payment. Sellers will come in and finance the whole thing, take all the risk, everything else. That basically went away after 2015. That's back. So what happened is the rise in interest rates for smaller markets and smaller assets, that really obliterates their value because the people that are buying it are pegged to interest rates very, very closely because institutional funds don't go to the smaller assets or the smaller markets. So when interest rates rise, it adversely affects values of asset classes in those markets because of the people that are buying them. They can no longer buy it at 3%. It's now at 6%. So they got to pay way less to get the exact same return. Well, now owners don't want to get less. So then all of a sudden it becomes, okay, well, I won't pay you less, but you have to be the bank for me so I can afford it and do it. Because whether the price doesn't matter, the bank's not going to give me money at that price. Well, now they're all saying, okay, we can do this. Or we can get a bank to finance it and I can have a seller finance half of it, meaning I don't need to put any money into it. So it's getting to be a really good time to get back in storage. And this is for those smaller markets and third tier markets is a great opportunity for individuals. It's where I started. But it's not only an acquisition and a financing part, it's also a management part. These are run by very much mom and pops. I mean, a business model to be successful in storage in most of these markets is really simple. It's answer the phone and collect bills, which is more than most of those owners are doing. And you can really, really increase. In fact, I just did a podcast yesterday with a guy on my self-storage podcast who walked through how he got it, owner financing. He put basically nothing down and doubled the value in a year by doing basic stuff, nothing that any normal person couldn't do. And that's the kind of stuff that is very hard to find in other real estate asset classes that storage still offers. Now, when you get into bigger markets and bigger asset classes like the kind I'm in, that's different. I don't get those prices. I don't get those deals because there's so much demand from big money. And so I'm buying them at 4 caps. I'm having to get institutionalized financing. And in order to get yield, it's a lot of work and a lot of expertise. We do things like dynamic pricing, which are what like airlines do. And so our prices are moving every single day. And we're doing intense revenue management. And we have marketing platforms that are doing intense marketing things. So when you get into the big assets in the big markets, it's outrageously institutionalized. And it's a whole nother game. But that money has not spilled over into the vast majority of markets in the United States.
Okay, so let's define. Okay, so you're saying the owner financing opportunity is in play now for beginners, and as you say, you had someone on your podcast. Go ahead and give them the podcast name real quick.
Self-storage income.
Okay, yeah, so you can find it on YouTube here, which is I've delved into a lot of them. It pops up on my feed all the time now. But what type of properties should you be looking for? Because I know you broke it down. You have your properties that and it's based on the rentable square footage, not really the units.
Yes.
One of the podcasts I was watching. So I think 50,000 or less is considered a small unit, a small. How did you define? I know it went from 50,000 to 100,000, then over 100,000 to different asset classes or whatever.
Yeah. So every asset class, as you know, we kind of have our own language and we have our own way to look at value, things like that. In multifamily, it's usually looked at a door basis. So how much did you pay per door? How many doors there are? That doesn't make sense in storage because storage has such a wide range of products. So I view it like a business. So I view units as products, right? And we sell 5x5s climate controlled, 5x5s not, 10x10s, 10x20s, industrial leasing space. Like there's a lot of products that we're selling to different customers that are not the same. Now in multifamily, you're selling to one customer. That's just somebody that needs a place to live. They're all using it for the same thing. Now you get a variety of desires and wants and needs. I need 3-bedroom. I need 2-bathroom. I can afford this. I can afford that. So there's variety in multifamily product based upon wants and needs. But self-storage, we actually have a variety of products based upon the users, whether it's a business, whether it's an individual, a man shop, whether it's moving, whether it's, they actually use them for radically different reasons. So when we're looking at it, we can't judge it by doors because it doesn't make sense. So we have to do square footage and we only look at net rentable. So how many net rentable square feet do you have? Let me give you an example. If you have 100,000 plus net rentable square feet, that is easily 5+ acres of net rentable square feet being used. These are the big boys. These are the ones that you see on the side of the freeway. They're multi-story climate controlled, right? Then you have 50,000 net rentable square feet to 100,000 net rentable square feet. This is our mid-range, right? So this is actually the majority of all the product will fit somewhere between 50 to 100,000 in larger cities and medium-sized cities. Once you get out of that, you're moving into the smaller range, which is under 50,000 net rentable square feet. Now, to an individual that looks at like a house, to them, that may still seem like a lot, right? So I'm like, 40,000 net rentable square feet. Are you kidding me? I only have 2,500 in this net rentable square feet in this flip. And you're like, yeah, but that flip probably cost you just as much as a 30,000 square foot facility in a small town. So it's, don't get confused with square footage and price because those don't make sense.
Yeah. Yeah, go ahead. I have one of your videos I was watching. You gave the example of you could, maybe I read it on a post that you had. I don't know, but you said, well, you could spend 500,000 on a house and collect, I don't know, what, 3,000 in rent on it, and you can buy a self-storage facility for the same amount and collect, I don't know, 12, 13,000 in rentable space or whatever. So if you can break that down and what that really means, not saying people can't still make money with houses or whatever, but just spent the same amount of money for 3, maybe 4, if you're lucky, $4,000 in rent or whatever. So if you could break that down.
And doors. So like if you go to a small market, we got a small market where this guy's buying, he bought, it cost, let me think here. It was $600,000 and he had 100 doors.
Oh, wow.
Yeah. Think about that. So think about if you could raise the price on every single one of those doors, 10, 15%, what that does to your net profit.
Wow.
And for storage, it's really easy because the price is so low. So raising 15%, let's even take 20% on somebody that has $100, that's $20.
Yeah.
Think about raising 20% on somebody that has a $2,000 rent.
That's $400.
Yeah, they're gonna start screaming at you. Like that's
for them being able to rent that place or not, basically. Yeah,
exactly. You're exactly right. Whereas in storage, it costs more than that to move. So if you're mad about that extra $20 a month and you say I'm moving, it's going to cost you $200-300 just to move. So you'll actually pay more to get away from the $20 than you would just paying it. So nobody moves. But that $20 increase doesn't sound a lot, but apply that over every single month, 100 doors. And now think about what that does on a
Yeah.
yearly basis. You just increased over $20,000 a year your net. Now, to give you any example of the power of that, and this is where people don't get really, like, I think it starts to shock them to understand. Take a simple formula where you increase just $20 a month and people basically aren't going to move. Well, on a net operating income, because we remember we judge these things on cap rates, okay? Now, if you took that at a cap rate that we see it traded in the market, that $20 equals $300,000 in value. So the guy bought it for $600,000, right? He put $168,000, which was seller finance down. He increased just $20 rent. He made double what was seller financed to do the deal. And he did it in 6 months. So he put nothing into it. 150,000 seller financed was his down, raised $20. He made 300 grand in value and $20,000 a year in net profit. That's the difference.
That's the difference. Okay. So if can you just really quick, like when you say you have a seller finance deal and basically, with the right opportunity, you don't have to actually put anything down. Would you go through a simple scenario like that, say like a $500,000 facility? If you could just run those numbers for us really quick on how that works.
100%. So let's say you have a $500,000 city. You're in a small town in the Midwest, right? Let's say there's 25,000 people. You're from that city. That could be anywhere. Let's think Georgia, Tennessee. Let's think, anywhere, Kansas, doesn't matter. And you go into that city, it's $500,000. And you're like, listen, seller, you don't have buyers rushing. Prices are higher. Now, the owner, like most normal owners in those cities, he's not actively collecting rent. So their delinquencies are like 10% almost always. They're not marketing. They never raise rents because they don't want to be bothered by it. And they're not working on the property at all. So you come in and you say, all right, it's $500,000, but I can't get a bank loan for that. So instead, what we're going to do is I need to put 30% down in order to get a bank loan that is going to be worth anything on this property. So if I have 500,000 and I need to get 30% down, that's 150,000. Mm-hmm. Now, the problem here is, though, I need to put another 100,000 into it because I want to make it look nicer. I'm going to paint it up. I'm going to clean it, right? So that's now $600,000 that I'm actually going to need. So let's take that. That on 30,000 is 180. Well, let's make it 200,000 just for operational cost. This is what we're going to do, seller. I am going to take out a loan. You are going to owner finance $200,000, and I'm going to give you a check for $300,000. I have another $100,000 to do repairs and maintenance, right? From the bank loan, because the bank loan's $600,000. Mm-hmm. The money down that the bank needs is the owner financed part. I'm not putting any money into it. Mm-hmm. Now I own it. I take the $100,000. I put that into it. I make it just look nicer, clean up weeds, maybe do some gravel, some paint. And then I go in and I make sure the bills are collected. That's a 10% increase in gross revenue. Okay. Then I maybe raise rents, make a website, do marketing, very simple stuff. And then I increase rates by 20%, which in most times isn't even $20, right? All of a sudden, I've now increased that revenue by 10 to 30%. Well, on an asset like that, that's more than the entire owner financing part in value and everything else. So now I've massively increased the cash flow, what I'm making. I put nothing into it, and I fixed it up and made it look nice. So I can, two options. I can live on the cash flow, or I can go refinance it now, pay off the owner financing part because I've increased that value. Mm-hmm. And then I just have a normal traditional bank loan. But honestly, why pay off the owner if they're willing to finance it at that rate? So that's how you get a deal, improve it, make more money, and all at the same time, not putting any money down.
Okay, so just to make sure I understood you. All right, so you're getting him to so the bank is requiring 30% down on 500, so that's 150. All right, and you're going to get him to finance the rest of it plus the cost of repairs. You mean the owner? Would the owner be taking a balloon payment, or are you making monthly payments based on a certain interest rate, of course?
Normally it's a certain interest rate, and then there is a balloon payment. That depends on owners. Usually I like it 10 years out. You also have to remember that most owners aren't selling to get money. That sounds so counterintuitive, but a lot of people don't understand this about sales. That the money is the byproduct of what they're trying to achieve. Most owners are selling for other reasons. Divorce, hard time in life. I don't want to deal with this anymore.
Yeah.
So price is actually not the leading factor. Now, the problem though is with a lot of them too, I still need money coming in. So I'm going to give you $300,000, then you're going to owner finance this, and I'm going to pay you whatever it is, $2,000 a month. The owner says, great, I get $300,000, I can pay off my house, plus you're going to give me $2,000 a month, so I'm still making income. You just solved a lot of problems for that owner.
All right. So just the last part of this, so he gets $300,000. Is he giving you $100,000 back at closing for the repairs?
So the bank does. So the loan is actually $600,000.
Okay.
You give him, so if let's say that it was $500,000, he's going to finance the $150,000. Okay. It goes to $600,000 because you want repairs. Okay. So the spread then, and you're going to just move it up to $200,000. Ask him to do that because we want to do simple math here. You're going to give him the $300,000 from the bank note, and then the money down is that $200,000 that he's owner financing, which he didn't have to give the money because it was in the asset. So the bank just looks at it as that's value or down. All they care about is the loan amount and how much they have to give on the loan. So now you're not putting anything in it. He's not either. He's getting $300,000. You get but what the bank gave you was $400,000. Okay. That extra $100,000 you put back into the property, fix it up. You have a payment to the bank and a payment to the seller on the $200,000, right, that he has. Now, you have two choices. You can just live on the cash flow, right? You can pay him off, but most of the time, it's way better to have the owner financing carrying it, so you just keep it going, and you just keep improving the value and making more money.
Okay, so what would be, for someone starting out, what would be the best way to probably find a facility, a first facility, in your opinion, in today's market?
I have a theory. I call it being the bear. And it all comes off this idea that I heard a story once, and it was about, I live out west. So I grew up, I'm a fly fisherman. That's what we do, because apparently we don't have enough to do here. So we go out, we fly fish. And the idea is that we go through all this work to try to catch this fish. We're imitating hatches. We're looking at the pH of the water. Super nerdy crap to catch a fish, right? And it's all this work that fishermen go through. And then you got a bear that freaking walks out in the middle of the river, sits on a waterfall, and the fish jump into his mouth. He doesn't do anything. That's why he's the bear. He's the big boy. They just jump into his mouth, right? Well, the idea about finding deals is you want to make the conditions to where the fish just come to you. Stop hunting the fish.
I got you.
Put yourself in a position where they do it. We do this in 3 ways. The first way is networking. Go to all the groups you can do. Go to the local ISS events. You need to be networking with people that are in the business. They actually own assets. They're trading and selling. The second way you do it, which actually is probably the first way, is brokers. You need to tell every broker that you know what you're looking for and what you want. And you need to be specific. Don't go to a broker and say, do you have any good deals? Because the broker is going to say, what's a good deal? Yeah. That's different to every single person. So you need to say, I'm looking for a mom and pop facility that most people don't want to buy. And so they have very little options, and that's being run really poorly. So I can do the minimum to improve that cash flow. Then the third thing you need to do is you need to be going out and actually going directly to owners. So you need to start building out a list of assets and owners in your space, and then you want to provide value to them of some sorts. So I like to make connections. This is the whole reason that I do content. Why? I'm trying to be the bear. I want people to give me deals, and it works very, very well, right? So you need to put yourself in the space. You need to put yourself in the networking groups. You need to get in with the local associations. You need to work with the brokers, and you need to make lists of owners in a market that you want. So I'm moving into Tennessee in a big way. I love the state. I love the whole Southeast, right? We're really bought into it. I need to be immersed in that local state, in that place. I need to know who's doing what. I need to understand it. And then I start to reach out and people start calling me. So what I try to tell people, if you're interested in the space, immerse yourself in it. Like really dive into it. Every asset class is its own world, right? So you do a lot of fix and flips, things like that. That is a world I literally don't understand. And it's like the people, I have lots of friends that do it and they kill it, right? They have their own, but you guys, you know who the people are in the space. You know what they're doing, right? You understand who's the good ones, who are the bad ones, who's actually providing value and not. That gives you an edge. You got to do the same thing in storage. And so start to immerse yourself in the space, understand it, network, and put yourself in a position where deals can come to you.
All right. For someone starting out, we see these buildings all over the place, the former Kmart, some even Walmart from a few years back when they did some downsizing, just a lot of the larger outfits, 40 to 100,000 square feet, big box with the large parking lots. That's somewhat out of a consideration for someone starting out unless you have a lot of capital, right? Or is it still an opportunity to locate something like that and someone like you get involved or whatever? What are your thoughts on that?
So I think there's two sides, and this is actually a fantastic question for anyone new start. The level at which you get started, to me, is actually irrelevant. Your ability to find other people that can do it. Like, as you know, with real estate, you don't need money, and you actually don't need to know how to do it. You just need a deal. You can find people that can do it and you can find money. You just need a deal. So when I look at it and I say, I have deals that people have brought to me that I have then done and operated, including a bankrupt Super Kmart. They said, hey, I got this bankrupt Super Kmart and everything else. We go do it. Then the expertise, he had never done storage ever. We walked in, brought all the expertise. We did a deal. We built the whole thing for $7 million. We put $2 million into it. We also brought somebody else in to help with the capital who brought the money in. And 4 years later, we had it under contract at $35 million. So I don't know what that is. That's a $28 million profit in 4 years, or, however that works. And so when you look at it, you can do big deals. You just can't do them alone. And I think when you're starting out, right? Now, as you gain expertise, you can and everything else like that. But when you look at these assets and these deals, like these bankrupt Super Kmarts, they are probably the top in our industry of what might be not difficulty, but there's just more parts to it because it's a conversion. So if you're building from the ground up, you hire a builder, he makes the plans and builds it. But when you're converting, you got to change lots. You got to work with the city. You've got to get approvals. Then you got to work on the actual structure itself. Then you got to build the units out. Then you've got to make sure it's a good market, not a bad market. So the complexity rises. So you just need to make sure you partner with somebody who has done it and understands it.
All right. Question do you only do deals? Now, the way we define A, B, C, and D areas is normally based in the single family, at least the way I define it. And this is not any slight to any one neighborhood over other. I'm just because I know most people are going to be familiar with this. Beverly Hills would be an A neighborhood. May not be, but that's my perception of
exactly
that Los Angeles market. Compton would be a D neighborhood. So if you know what an A is, you can sort of figure out what a B is. If you know what a D is, you can sort of figure out what a C is. I would say, okay, but with self-storage, do you, as far as the neighborhoods, I know it goes into the demographics, the income, the population density, all of that. But it can be a very densely populated area, but it may be a D neighborhood. Are those off limits on your investing strategy? Or if you could give me like, what's the minimum? We won't go beyond this point of trying to find a facility. I don't care what the density of the population density is.
Yeah. So you hit on something that's actually really, really good. First of all, the classification, like you've said, we do use and we look at it. But in self-storage, what's way more important to us is supply. So the number one threat to self-storage is self-storage.
Overbuild.
Self-storage is the number one threat. Yeah. It can oversupply a market. So if I'm in an A-class area and they're building storage everywhere, and then I go to a D-class area and there's like no storage at all, so demand's super high, I would take the D-class area because it's way more dangerous in the A-class area. The problem, though, is that other layer, and that's what you can get for rents. And the reason why this is a problem is it's really expensive to build right now. So if you're in a D-class area where let's say the average income is $35,000, right? And when you look at it, I have a guiding rule that is a 2% rule. So the 2% rule means, excuse me, the 2% rule means that like they're going to spend at most probably 2% of their income on storage. Well, that means that in a neighborhood like that at $35,000, you're talking about $70 a month. Yeah. Well, at $70 a month, if you're in a highly dense, if you're in LA, if you're in Compton, right, it's going to cost you a lot of money to build. Mm-hmm. And that probably won't work because the building costs to what you can get in rent are going to kill you, right? So that's two sides, supply, and then what it costs to build versus what you can get in income. And we saw it used to actually not matter hardly at all. Mm-hmm.
Well, let me ask you this. So in the D neighborhood, it would be, if you're going to do it in the climate that it is right now, it's probably best to buy an existing facility that's undermanaged. If you're going to
100%, yes, because then it's valued on a cap rate. So you're paying on the income. So I don't care what the cost to build is. Yeah. And you're going to get it actually cheaper than you could even build it for because of the income. So that offsets that problem right there. So when you look at my strategy, it actually illustrates this perfectly. Let me tell you where I'm buying. I'm buying in submarkets of Tennessee, Oklahoma, Kansas. Guess where I'm building? I'm building in Phoenix, Arizona. So the reason being is the incomes are double, growth rates are double, right? But I don't want to buy in that market because more people are building and the price to buy is so high that means my risk is way more. Whereas I can go in these other markets and I can buy these assets cheaper than I could even build them.
Well, what do you, and I know it's going to vary from market to market. What can you build per square foot, generally speaking?
Yeah, so you're right. This is going to vary greatly. So I'm going to throw out some numbers, but don't anybody hold it to me and say, AJ, you said this. Well, obviously, if you're in California versus
Birmingham, Alabama,
it is going to be astronomically different, right? If you're in Birmingham, you're talking like $40 a square foot.
Okay.
If you're in California, you're at 150 to 200.
Oh,
so
okay.
If you're in a major metropolitan area in California, I mean, I've heard of people at $300 a square foot to build, which is astronomical. Now, if you're in a middle market, let's say that you're in just a normal market, a good rule of thumb would probably be $60 to $100. Now, I'm building super nice facilities in first-tier markets like Arizona, which is expensive, and I'm at probably about $110 a square foot in those markets. Now, that's not California, right? That's not the New York, right? Those kind of things. Get those out of the way. But to build a really nice facility, I'm talking 4 stories, 250,000 square feet, freeway exit, big signage. We're doing dumps and all that stuff. It's $110 a square foot. Now, if I'm in Birmingham, Alabama, I'm not going to build that kind of asset. I'm going to build your traditional drive up normal storage. And if I can get land for cheap, building costs low, that's probably going to be, but it's still nice. Like I'm still building an office and building a nice, you're probably talking more around 60 to 80 bucks a square foot.
Or when you give that number, are you including the land acquisition or the property?
I am.
Okay.
I am.
All right, cool. All right. So
that's an all-in number that you could roundabout see.
Okay, cool. So what, and I guess this is still there, but these are the questions I got. So what percentage of that, what percentage of the land is that $40 a square foot or $100 a square feet? Well, what do you expect the construction cost to be versus the land or property acquisition?
Yeah. In nice markets, it's 10 to 20 bucks of the 110.
Okay.
And in lower tier markets, it's like $2 to $4, $5, maybe at the most. I mean, you're talking, $2 to probably $5 of the 70, 80 bucks. So it's a vastly different piece of the pie. Hence the reason why you look at it. And if you're building in those markets where I'm paying $15 a square foot for land, rents, I need to be getting, like, if I'm in that kind of market, I need to be getting $2 a square foot a month. You're talking $24 a year. If I'm in Birmingham, Alabama, I could probably do it at $10 a year, maybe $8 a year, because that price difference is so big.
I got you. Interesting.
So if you're in a market like we talked about, though, Compton, where you're still buying and building at $150, but they can't pay $2 a square foot a month, they can only pay 80 cents. You're underwater.
Yeah.
In a big way.
Yeah. Okay. All right. Wow. A lot of good information, AJ. So someone starting out, obviously they need to educate themselves. You're putting out a lot of good content, especially on YouTube through your channel. If you could just give everyone number one, let's before we go into that. Okay, so obviously you're looking for endless opportunities, right? You know the money is there, whether it's yours, combination of both. If someone wants to, if you say, hey, if you find this, DM me, what would that be?
Yeah, 100%. We are open to all opportunities and options. I have an acquisition team, underwriting team that we can go through them pretty quick and tell you. Now, we have a buy box, which everybody should. First of all, our buy box needs to be 60,000 net rentable square feet or more. It makes no sense for us to go down below that. So that we need. We also need it to be in a market that's over 50,000 people, and it needs to be growing. The reason being is our model doesn't focus on cost. We're not a traditional real estate model where we're like the rent to cost spread. I'm looking at it and saying, what can my business operations in the back end that we have, how much can I drive revenue? And so in order to do that, I need growth and I need some stability and I need a bigger facility. If not, the smaller the facility gets, the less power I have over doing the things that I do in the back end. So that's our buy box with our overall strategy. You're interested in anything else like that? Once again, you can reach out. You could actually probably just go to selfstorageincome.com or Cedar Creek Wealth, which is my private equity company. Email us, and we get those emails and we go through them. It goes to our underwriting team, and we can talk about it. If you're looking at just learning, I wrote the best-selling book in the industry. It's called Growing Wealth in Self-Storage, and that talks about everything that we covered here, obviously way more. It talks about the actual acquisition process. It talks about finding deals, all that kind of stuff. And then YouTube, Instagram, and the podcast that I do, which are dedicated to self-storage. Everything from valuing to underwriting. I mean, you could just consume all day long to learn about every single piece. I don't talk about anything else on my self-storage content. So it goes very, very in-depth. And so if you're in it, it's baptism by fire, but it's all there.
How often do you all produce new content? Is it weekly, a couple times a week? Okay. All right. Weekly.
Yep.
All right.
Every week I'm doing podcasts, Instagram, YouTubes. We'll do YouTubes on actually walking through our sites and underwriting it and saying, This is what we're doing. This is how you do due diligence. So once you find a deal, what do? Right? Well, we actually show us going and doing it and doing the walkthrough on exactly how to do it.
Yeah, I seen one with a couple of your guys loaded up. You were in a truck. I forget what city you all were in, but yeah, that was an impressive video there, man. I think we've gotten a lot in here, man, and almost an hour. I really, really appreciate you doing this so quick, compared to when I reached out to you through Instagram. And anything you want, last words you want to share with anyone that's thinking about doing this, or just anything that they really want to do in life, but definitely this.
I really look at it. I think one of the reasons, obviously, I'm passionate about it is what it did for me. I don't really care about metal boxes, but I really care about how it changed my future and how it saved my family in a time of need when you're 33, married with 4 kids, and that happens to you. And so it changed the way kind of I look at it, but also I think it's the best opportunity for any investor to get into commercial real estate. The most upside, the lowest risk, but more importantly, the most opportunity. There are more self-storage facilities than there are McDonald's and Starbucks combined. People don't understand that. The amount of storage facilities out there for a newbie to go and find and buy is crazy. That's one of the reasons I got in the industry, because I could scale and I could compete. I can't compete with the multifamily guy because I don't know that much about it. And they're all going after the same things. They're even in submarkets where there's just endless mom and pop facilities that are being ran like trash. They don't even answer the phone. And you can buy them and do the bare minimum and make money. So it's the best commercial real estate asset class to get into if you want to get into commercial real estate, I believe.
What just one thing before we go, if someone is going to submit something over to you, what's the obviously the more information that they can gather from you, gather for you, it keeps your underwriters from wasting a lot of time. What's some of the bare minimum things they could get if possible, whether it's a old Kmart or something that's not been listed or that's off market or whatever. I don't know if that makes a difference to you. Or if it's some land next to the freeway that they see or whatever. What's some of the bare minimum things that they could do?
So first of all, a detailed address, because all we're going to do is we're going to take an address, we're going to put it into our system, and we're going to look at every single storage facility around there. We're going to look at rates, population, trends, and then from there, size, how big. And then that tells me everything I need to know. Our team can do everything else because I'll either know immediately rates aren't high enough, there's too much storage here, or high density, it's growing. These are all the things that we want to see in it. And it's big enough to make or break it. Like with that, I can make a buying decision immediately. From there, it comes down to price.
I got you. One last thing. So when they gather that information, what type of compensation, or they be partnered in a deal, or just a referral fee, or it just depends?
It really depends. So what we look for is 2 things. First of all, are you actually going to be involved in the deal? If not, then it's like, well, do you just want a referral fee? If you're like, hey, I actually want to be involved in the deal in some way that we can work out, right? And I'm bringing it, I don't want a referral fee, I want a piece of equity. We do that too. So we're open to those kind of discussions. Now, I will say this. I've had a lot of people that say, hey, I want to split this 50-50. And I'm like, well, you sent over a listed deal on market. You've never done this before. I have to do all the work and all the money. We need to be realistic with risk, reward, and that kind of stuff, and effort alone. So like it's kind of a non-starter when somebody sends me an on-market deal from some broker shop and says, let's split this 50-50. I usually just reply, why? Then I don't get much back after that. So just when you're going in with anybody, and I think this is just, a lot of times people are young and they just don't understand or anything, how you present it. And I think with anybody, whether that's you, whether that's me, you want to do a deal with somebody, I have an opportunity I would love to be a part of. I don't know how that looks. I think it's a good one. Would you be willing to look at it with me? And is there some way we can do business together? I am immediately interested. You are a logical, reasonable person that is trying to provide value. And that I like and I honor, and I'm I do deals with people all day long. It's actually probably the number one method that we do and get deals.
Wow, that's what's up, man. Woo, this was a good one. This was a good one. You're going to get a lot of action. It may not all be good. You're going to get a lot. So once I edit this, I'll have all the contact information. It'll be in the description of this video. So again, AJ, man, we really, really appreciate you sharing your time, your unbelievable knowledge. The energy is great. So because you're entertaining, you're holding attention. This is great, man.
Thanks for having me on, dude. You, by the way, too, seriously, at a podcast and content, you killed it. Like, it was really easy to have a conversation with you. You do a good job, man.
Well, I'm really just asking questions for myself, you know.
Yeah.
So
that shows because it's the legitimate good questions.
Yeah, because I'm sure there's other questions people will have, and they'll post them in the comments or whatever. But those are just questions from me and what my little knowledge of. I've wholesaled a couple of self-storage properties over the years or whatever. But so it was just coming from that own personal input there. So again, guys, please, this man is out here. He's getting it, and he wants to get more. He wants to include you. As he said, be reasonable. The more information you collect on a property, stuff that's listed, they can find that in most cases. You know what I'm saying? So stuff that's already for sale and listed online, or that stuff they filter through all day. Find something that's not. You've already contacted the owner. You have their contact information. You have an address. Make it easy for them. Make it easy for them to help you get paid, create a win-win situation. So, again, we appreciate them for showing up, man, and sharing all this free game. And as I always like to say, guys, we'll see you on the flip side.
Thanks.
Text me and I'll text you back. Text me and I'll text you back. Text me then I'll text you back. You text me then I'll text you back. Text me then I'll text you back. TikTok, you don't stop. I will help you make your paper stack. Where you at? Where you at? Where you at? Where you at now? 205-964-5243. Now you know. 205-964-5243. Now you know.